As a syndicator, I love it when I pay above the preferred return because that means I get to pay myself as the manager. But that means that the investors are doing above and beyond what the preferred return is, which is always great.
Welcome into the Get Invested podcast, a podcast about all things real estate and real estate investing, brought to you by Capital Velocity Investments and a part of the Matthias Talks Investing Substack.
Hello, everybody. Welcome back to another episode of the Get Invested podcast with your hosts Jordan and Matthias. As always, we're excited to be here and to talk all things investing, real estate, and real estate investing. Today is part 2 of an investment metrics breakdown. Part 1 last week covered average annual return, total return, and the equity multiple. And then we just kind of talked about what their function was, is how to read them, how to compare them, how to look at them across different investments, and just broke those down a little bit. And today we're going to do the back half of that and break down internal rate of return, or IRR, what's called cash on cash, which is the most rap lyric version of investment metrics, and then preferred return and how that connects with cash on cash. And then a little bit, I think, probably just getting into the idea of preferred return to make sure that we're all on the same page on that. Now, before Matthias launches in, I was just going to say that last week's is really focused more generally on like what the metrics mean. It could be real estate. It could be other things. It could be real estate syndication, etc. The metrics we're going to talk about today, although they don't pertain specifically to real estate syndication, they're very much more part of this type of investment and really come to bear a lot on what we do. So we're going to get a little bit more into the specifics of what we do versus last week was very much just investment in general. Do you agree with that before you jump in?
Yeah, I do. These are, and obviously when we talk about preferred return, that's very specific to private equity type investments and private offerings. So they're going to be more specific, and anybody investing in like stocks or index funds or whatever is never going to have heard about preferred. They might have heard preferred stock, but that's still going to be confusing. So we'll get into that. But so these are definitely more specific and focused, but they also tell a good story about how this investment or this type of investment would compare to other types of investment, whether they're similar syndication type investments in real estate or just stock market, anything else. There's metrics and ways that the return that you arrive at the returns, the total returns, let's say, and these metrics that we're going to talk about today tell you a lot more about how that money comes to you.
Yeah, much more specific, exactly, of how it comes back, when it comes back, how frequently it might come back, et cetera. Yeah, and then so this one's going to be a little bit more detailed than last week's. Before we jump in, I don't want to retread too much of last week's, but in case you're just jumping into this one because you're like, I don't need the basic one, I'm going to the more advanced, or you just stumbled upon us and like, what are these yahoos talking about? We just want to say up front that when we're talking about these metrics, we do have to understand that these types of numbers and projections can be arrived at in different manners. So one of the things that you do have to look into is what kind of inputs produced the numbers these projections, right? If you're looking at the investment summary or the pitch deck, how exactly did they underwrite? What kinds of assumptions are they making? What kinds of things are they hoping, et cetera? And Matthias will break down that a little bit more. I just want to.
Yeah, that's a good way to start, just like we did last week. Bulk wrap in, bulk wrap out, right? So if you're putting bad assumptions into whatever model is producing these projections, you might as well be, writing in crayon. Who knows? So obviously, your job as the investor is to not only evaluate the metrics, but then evaluate how they got to the metrics. Whether it's a company making stuff up, a syndicator like me making stuff up, hoping that things will go extremely well, so I'll have these good numbers. It's up to you to critique and ensure that you understand how they got and why they got to these metrics or these numbers that are being produced and put on whatever piece of paper you're looking at. So again, if there's garbage in, then you should not trust the numbers. That's what I would say.
Right. Because these numbers are essentially the most important on a presentation of a business plan, investment summary, or whatever, where they say this is what we think it will do. Now, obviously, these numbers can also come at the end where it's like, in reality, this is what our performance. And obviously, people like us, we trot those out when we're trying to show people that we know what we're doing, but that's a different time. So typically it is projections, even though we're calling them metrics, it's projections. So
yeah. Yeah, so we'll start off and we'll discuss the kind of the cash on cash return and preferred return. Start off first. So actually, I think I'll start with preferred return. It's a new subject for somebody who hasn't done this type of investing. It's a new term. So yeah,
Bringing up
let's
the
look at it.
website here, by the way, just plug. We have all of this on our website at capitalvelocityinvestments.com. Scroll down to there's a frequently asked questions section and a investment terminology section where we have a lot of these things broken down, and there is linked articles and episodes of this podcast that get into it in more detail. All right.
Yeah.
Let's talk about preferred return.
Yeah. So preferred return is basically a percentage based on how much an investor invests that will be returned of the profits first. So priority in profits goes to a preferred return. In this example, we put very simple stuff. So basically, let's say last week we used an investment of $10,000. So let's say we're using $10,000 again, and there's an 8% preferred return. Industry standards can vary widely. Some are more about cash flow, some are more about flipping and increasing in appreciation, different things. So it's hard to, just like I said last week, it's hard to give industry standards for these metrics. But let's say in this scenario that we're discussing today, 8% preferred return. Basically, let's say that there was $10,000. 8% preferred return means the first $800 of profit would go to the investor before of profits. This is net numbers. This is not gross numbers. This is after all expenses are paid, all reserves are stored. So before any other profits go anywhere else, theoretically to a manager or to any other type of investment on this property or this, let's call it this entity, the first $800 of profit go to the investor. And the reason we use preferred return and why it's important in this type of investing is because managers or syndicators, people like me, yes, this is a day job, so it takes a lot of work and a lot of effort and a lot of risk. And we've talked about that in other episodes, but basically we take a cut, right? We take a cut of the profits on a property for presenting and operating the opportunity to all the investors. So, but in order to kind of align incentives a little bit more, meaning that I'm incentivized to shepherd the property as good as I can as a syndicator, we do this preferred return, meaning I don't get paid until investors get paid X amount, right? So depending on the percentage of the preferred return, we set all of ours up with the preferred return. Most people who do what I do as a way to say, hey, we're here. Yes, this is our job, and we will make money doing this, but we're incentivized and the structure is set up so that the investors make money first. Removes they're at the lowest risk of anybody operating in this investment. So there are some important things to note about a preferred return, though. Notice it comes out of the profits after all of the expenses are paid and all the reserves are set aside and so on. There's no guarantee that you will make your preferred return in any given year. This is annual, by the way.
Yeah, this is 8% per year.
Per year. So that's an annual number. So each year that $10,000 is in the investment, if the investment has an 8% preferred return structure, then you could expect the first $800 of profit would go to the investor each year. So for the life of for as long as the investor's capital is in the investment. And we can talk a little bit more about that.
Yeah, that'll be key later.
Yeah. So for the preferred return, let's say in the first year, there's only $400 of profit. That means that the investor would get the $400 of profit on their $10,000, but there's no guarantee, like the investment isn't going to go into debt to pay everybody's preferred return. So it's important to note that the preferred return is calculated off of invested capital, and it's only paid out with profits. It would be a terrible idea to sink the whole investment by paying preferred returns. If you use all your, all your capital to pay out people, then you can't pay your bills and the bank takes it all back. That's a bad plan. So that's important to note. Also, not always, but industry standards are cumulative preferred returns. So let's say in this scenario, the first year, and it's actually not that uncommon at all. Oftentimes you buy a property and it takes a little while to onboard the property, to fix some problems on the property, or to just get everything set up before you start paying your distributions of any profits. So you might not make that whole 800 the first year. You might make only that 400. But when it's a cumulative preferred return, and it doesn't always have to be, so it's important to check your paperwork and make sure that is indeed the case if you're expecting it, that the remaining $400 that you didn't get paid from year one gets thrown on top of the stack for year two. So you got $400 in the first year. Year two, you're owed $800 for that year, right? According to the preferred return structure. But the $400 that was left over that you didn't get paid from last year is added on top. So technically, in year two, you're owed $1,200. And once again, maybe you don't make $1,200 that year on the $10,000 investment. So now whatever's left over, so on and so forth. It's cumulative and it keeps stacking until it's all paid off, where your 8% is hit over the course of however many years it takes to get there, or while your money is in the investment.
Right. So let's just unpack a couple of those things. There's a lot there. Mm-hmm. First, I think it'll be helpful. We're going to say the caveat of all situations can be different. This is something that exists in other industries. And definitely if you're investing in a business, there's absolutely, like any kind of business, this absolutely could be the way that it was set up. Same thing. A business will need some runway to get customers built to a point where you're making the money. So I think that's kind of understood. But just for clarity's sake, I think maybe we can just stick to syndication as our examples moving forward. But I think most people understand, oh yeah, well, when you take over a property, especially one that's value add like Realtor, when it's underperforming and we're trying to bring it back to where it needs to be, it's going to take a minute to get there. So the key thing, as Matthias said, is it rolls over, like back in the day when minutes used to roll over, or your vacation days.
Wow.
Yeah, right. Or I really aged myself. Or vacation days roll over, right? It's on the tab. Now, again, you may never make all of it back if the investment doesn't do as well as projected. But as long as it does, the investor, and in this example, it sounds like there's only one, but each investor will be paid out first that amount before the people operating it, the general partners or whatever, make anything. And that's key. And as we put it, if you're looking at the screen here, it says protecting LP investors. It's a structure to make it clear that the people operating and managing and making money from just operating and managing the property are in it for the long haul, have the investors' interest front and center, will be making decisions that are best for the property. And because of that, including, though, downside, maybe not sending you any money for a while because it's the most financially responsible thing to do. The investor may not get anything because they need to consolidate, shore up reserves, pay for a new roof. The list goes on and on. And I guess my last thing on this is, it is absolutely possible that you will not get the rest of that 8% per year, right? Until sale, at which point it's made up then. Yeah. So if someone guarantees you a certain percentage every year and no matter what, you will get it that year, that's called a Ponzi scheme. So, but anyways.
I think we've covered the gist of it. I know it can seem complicated, but basically just think manager doesn't get the share in the profits of an investment until they've provided whatever the preferred return is to the investors. Think of it that way. There's no share of the profits to the manager until, and it's just a way, like Jordan said, of saying that, hey, that this is the investment is structured to provide returns to investors first and foremost. Yes, there are incentives that, as a syndicator, I love it when I pay above the preferred return because that means I get to pay myself as the manager. But that means that the investors are doing above and beyond what the preferred return is, which is always great. And we'll talk a little bit about that coming up next. So do you have anything else on preferred that you want to hit before we go?
I guess that's a good segue because there is a scenario, I guess, it's an 8% minimum. Like that, you make that much per year before the manager is paid, but it is possible for everyone, manager included, to make more than 8% in a year.
That's a good point. Yeah. So everything above that 8% each year, let's say it's a really high cash flow investment, more than that $800 are paid out. Let's say there's $900 of profit to be paid out. The extra $100 after the $800, that extra $100 will be split according to the manager investor split. And usually industry standards are anywhere from 80% to investors, 20% to manager, all the way down to like 60-40, 60% to the investors, 40% to the manager. And there's a whole bunch of different types of structures and variations on that. So generally 70-30 is probably like right in the middle there is usually where you're going to see most of them. especially the type of strategies that we do. But you never know. And just because it's different doesn't mean it's wrong. But theoretically, if the manager's taking a bigger cut after the preferred return, you would expect the preferred return to be a little bit higher. That's as a rule of thumb. But I think that's
right.
a
So
good,
that's a good segue, really, because what we're moving on to, cash on cash, actually is a metric or a measurement, depending on when you are looking at it, of what you might actually make in a year rather than what you should be making on average over the years as a projection.
Yeah. So cash on cash return measures the actual projections. Preferred return is how much are the managers planning to pay out before the manager makes any money. The cash on cash is what the projections mean. So like in the last episode, we talked about average annual return. We project average annual return in the example of 20% each year. Cash on cash return is how much we project to pay out each year. Very different than that average annual return because, as we discussed, that money could be coming at one big lump sum at the very end of the investment 5 years later, or it could be paid out in installments over the life of the investment. We don't know just from AAR. Cash on cash is one of the ways we can tell how that money is paid out over the life of the investment. So we'll go back to our $800 on $10,000. So if we pay out in any given year, we pay out $800 based on a $10,000 investment, that is an 8% cash on cash return. It just so happens to line up with the preferred return, but it doesn't necessarily need to. Most of the time, what you'll see, and especially in the type of investing and the strategies, business plans that we use, you'll see the cash on cash change each year. Because usually what you'll see is like in the first year, you'll see a relatively low cash on cash, maybe 4 or 5% or even less sometimes, depending on how underperforming the property is, let's say. Because you may be doing a bunch of reinvesting the profits into renovating units, maybe spending a lot of money, who knows, whatever the business plan is. But over the life of it, you expect, hey, the next year we won't be doing nearly as much. We'll have a lot longer, more steady cash flow, whatever it might be. You'll see the cash on cash return ticking up over the subsequent years in the investment. And usually what's projected will be an average cash on cash return over the life of the investment, meaning how much do we expect to actually get into our mailboxes or checking accounts each year of the investment. But you'll get that average. But then you should also ask to see like, hey, by year 1, we expect 3%. Year 2, we expect 5%. Year 3, we expect 8.5%, or what have you. But that chart will usually be presented in the information packet that you're given on an investment.
Right. So to reiterate and focus on a few things, AAR is going to say 20%. It's not going to break that down.
Right.
There's not going to be any breakdown. But a lot of times, I know we do it. I mean, I know a lot of people in our business do it. You're going to see an actual chart that says first 5 years, et cetera. We expect each year 1, 3, year 2, 7. I'm making these up, obviously.
Yeah.
Year 3, 9, year 4, 11, right, et cetera. And then I would say it's a strong investment if the projections build and the average ends up being more than the preferred return, right? It's a decent amount above. So they're pretty confident because, I guess we forgot to say this at the beginning, but we're assuming that all of these numbers are arrived at in the most solid way possible. These are all good numbers.
They're not BSing. We did briefly, but yeah.
Yeah. So if you see a COC that says 9%, for instance, and the preferred is 8%, then they're confident that they're going to make above that preferred return, which obviously a GP would want to do so they can actually make some money on their own. But it is broken out because this is a very specific projection, unlike the more general ones we have discussed previously. And I just want to make clear, it's called cash on cash. And this is important because we're going to tie it together with preferred return in a minute. It's the amount of cash you made as a percentage you made on the cash you have in the deal, on the capital you actually still have in the deal. Because in our world and the type of thing we do, it's possible to have equity in something without having the same amount of capital. So that's a distinction that Matthias is going to get to here in a second.
Yeah. And actually, there's 2 major things that cash on cash, when given in conjunction with the other metrics, the ones we've discussed before, and some we're going to talk about in a minute. You get to look at the business plan and distinguish, hey, how much of the total return or the overall return on this investment is coming back each year in cash, and how much is going to be coming back in a big chunk at a sale or a refinance. So that's important to gauge what are the main returns of this investment relying on? Are they relying on the cash it's producing each year, or are they relying on the value of the property going up and creating equity that'll be paid out on the sale according to ownership? So that's the first thing that cash on cash will help tell you. So you'll take that, hey, I'm looking at 20% average annual return, and I've got a 9% cash on cash return. That means roughly 11% of the returns. So more than half of the returns will be coming on the back end on a sale. On the other side, if it's a really high cash on cash and a relatively low average annual return, let's say it's 20 and then there's a 11% cash on cash. Well, most of the returns are coming from annual cash flow, right? So what that helps you do is that it helps you evaluate the business plan. Okay, well, are they presenting in this business plan a way that they're really going to increase the value of the property? Is it realistic? It's a way to help you evaluate the actual business plan itself. What is providing the returns? If there's a good balance between cash it's paying out or growing cash flows and growing value, or is it way lopsided and it needs one or the other? And it doesn't necessarily mean it's wrong, but it'll tell you that part of the story, and you should understand that.
Right.
The second
just jump in.
Yeah, go ahead.
Real quick. Like just to be clear on what that is, that's cash flow in this instance, and that COC means that the investment will be sending you amounts of money on whatever frequency that they distribute, whether it be monthly or quarterly or whatever it is. They're going to take, okay, we paid this is how much we made, we paid our expenses, our debt, we put our reserves, everything. Here's what's left over. We're sending it out to investors routinely versus, okay, we sold for much more than we bought. Here's a bunch of money.
Yeah, exactly. And then number two, an important factor for cash on cash return is this is a really good indicator of the safety margin in the investment. And here's why. If a cash on cash return is low, let's say it's basically your profit margin, right? Each year. It's because it's paid out after expenses and reserves are funded. So if your cash on cash return is 2% each year for 5-10 years, whatever, I'm making this up, that means you have a 2% profit margin above your expenses and reserves each year. Now, that doesn't necessarily mean that it's unsafe if you have 2%, but if it's a low cash on cash and it doesn't grow, you should expect to see significant reserves to cover fluctuations in the income on the property. So if you see a high cash on cash return, that often means that it's a high profit margin, high safety margin investment. Meaning, even if things go wrong, you're not going to be dipping into or turn negative cash flow if things settle. So the lower the cash on cash, the lower that safety margin is. There's varying business plans. So again, low margins don't necessarily mean unsafe. But if there's low margins, you should expect to see reserves, contingencies, and how you will guard against fluctuations in that income, because it's going to happen. Life happens always. So that's what I love about cash on cash. It tells you, like we talked about, it's a great way to tell you how much of the investment is allocated to each year's income, and it gives you that safety margin kind of measure that most of your other metrics are not going to. I mean, your sponsor should talk about safety margins, but cash on cash is a real hard number that should tell you what they expect in terms of safety margins.
Right. And that's a great point, by the way. But that projection that they say can also kind of give you a glimpse into, and they should have talked about it anyways, but kind of how long they think it's going to be to stabilize, say in our line of work, the property, right? Bring it up to where they think it should be performing. Because that's the other thing with Matthias. If it stays low, maybe they're just being super conservative and they just are sitting on just mountains of cash. They're just going smaug on it. But it could also mean that they're really not bringing it up to the performance that would mean that it's going to be valued at a much higher rate or a much higher price later because it's not bringing the
That's a good point.
Total income up. Right. So as I always say, like you just said, putting at least two of these metrics together is always going to be the way to give you a really good picture maybe of the investment's intent and how that aligns with what you're going for. Because you could be someone who really just wants to invest in something that's going to put cash out. You want your money to make money now. Or maybe you're someone who's in a situation where you're like, you know what, I'm going to park this. I think at the end of it, it's going to be a big payout. I don't need anything from it right now. So there's
right. And that's exactly, so it gives you those two things. It gives you one, how is this investment going to, or not going to, I suppose, get after whatever my individual goals are. And then two, it'll help you evaluate the business plan itself. If this thing is, according to these metrics, it's most relying on appreciation of the property or increased value of the property, but they have no plan for increasing the value of the property, then, hey, now I have questions about the business plan, right? It's a way to kind of measure the business plan itself and make sure it makes sense according to what's being presented. But yeah, so let's move on to the kind of everybody's tricky metric here, the IRR, the internal rate of return. So average annual return is total return divided by number of years. IRR brings in an even more specific metric of how quickly the big chunks of money come back to you, or how quickly your entire investment is made back. Think of it like that. And it's an iterative calculation, involves a spreadsheet. So this is not, as you see, this is the longest paragraph on our on our website here, because it's not a simple number to get after. I don't even want to get into too many of these individual numbers. We're not going to discuss them. You can read them on the website if you'd like. But the main point is that average annual return takes the total return divided by number of years. In our examples, it's always been 100% 5 years, so that's a 20%. Your IRR is going to tell you how much of that return, that 100% return, is coming back and how quickly it comes back. So in an instance where, I'm going to use broad numbers here, in an instance where that, let's say it's that 5-year deal, 100% total return, the IRR is going to be higher if there's higher cash being paid out each year of that investment than if there's no cash being paid out and it's just paid all in one lump sum in year 5. You get your whole $20,000 check at the end of year 5. So the IRR, it's low if it's only one check at the very end. It's higher compared to other IRRs, the more money that comes back quicker. So if there's a refinance before the end of the investment where there's returning a big chunk of capital to investors, the IRR is going to be much higher because you're getting your money back and it can compound faster. Think of it that way. You can reinvest money as you get it back. So it's going to be higher the more money is front loaded, the more the return is front loaded. Is that making sense so far?
Yes. So, ways to repackage that to expand the different ways in which we can understand. It's almost the higher the IRR, in a way, the lower the opportunity cost. Because that is essentially one of the things that they're measuring is you get that money back so that you can do something else with it.
Gotcha.
Which is why for a lot of seasoned investors, it's the one most important metric, because it's the one that projects how much money will be back in their control to do something else with.
Sooner. Yeah, exactly.
Yeah. So, and that, again, that can be a lump sum of, hey, we refied and you got half your capital back. And so that's really going to bring up the IRR number. Or it could be we paid out a high cash flow distribution, and then at the end you got your money back. Or some variation of the two is more likely, honestly.
Yes.
If it is higher. And so it's the one that it's hard to break down as a mathematical formula because it's an iterative function, but that is what it tells you, that they're projecting that they will be able to get you back cash or capital, right? Either they're going to pay you a lot on the money you invested, or they're going to send some of your money back sooner rather than quote unquote later. And I think that's this good distinction to make, because how that connects to cash on cash and preferred return is a high IRR can often mean that you're going to be able to pull capital back out of the deal, which is a good thing because you can do something else with it. But it also means for the preferred return that you're not owed that 8% on the original investment. You're only owed 8% on what is left at that point, right? So Matthias, you want to break that down a little bit? That's part of it.
So the preferred return is calculated based on what the investor has invested in the deal, capital invested in the deal. So in the event of a high IRR investment where let's say there's a refinance and half the capital, let's say half of that $10,000 investment is paid back. Now your 8% preferred return is calculated based off of whatever's left in the deal, that $5,000 remaining. So then the preferred return on $5,000 is only $400 on that 8% preferred return. So now $400 of the profits go to the investors first before that split to the manager that we talked about earlier. And this is exactly how it pays into incentivizing the manager to pay returns to the investor. After every dollar that the investor has paid back from an investment is one less dollar that's at risk for the investor, right? So if you have no money left in the deal as an investor, they've returned all 10,000 of this hypothetical money, you have no more risk in the deal. You may or may not continue to make returns on the deal, but you're never going to lose money on that deal if your money's out of it. So lowering risk is always number one priority. Well, in my opinion, should be number one priority for whoever's managing the investment, the syndicator like myself. So I'm incentivized to pull investor capital as soon as possible. One, to remove that risk, and two, because I get paid more or paid sooner on profits, the less the investors have in. So it's a way to align the incentives in a way that prioritizes investor safety and investor returns to the person who's responsible for managing the investment.
So that's a good way to frame it as far as the incentive of the manager to, I guess, manage well and put money back. I just want to be clear that if you have $10,000 in for 3 years, you are owed 8% on 10,000 for those 3 years.
Yeah.
And then whenever it leaves, you're owed 8% on the 5. So if they're catching up, you're still getting 8 until they catch up on the 8 on 10. And then it starts being 8 on 5. Now, at the back end, if it's really cash flowing, they're going to pay out that 8%. Then, as he discussed earlier, with that 70-30 split of the rest, if your cash on cash is staying steady, the amount that you have in doesn't actually dictate how much cash on cash, the percentage of cash on cash. So that could go way up because, I mean, it's just fun with math at that point.
Yeah.
You have less in, but you're making the same. So your cash on cash doubles. And technically, if everything has been pulled out and you're still getting paid on it,
That infinite.
it's cash on cash is infinite.
Yeah.
So that's fun for the nerds like me. But
house money, free money, think of it however you want to, but if you have no more money left in the deal, it's that's obviously the best way to earn money, right? And you don't even have to commit any capital and you're still getting paid. That's pretty sweet.
Yeah, because you have equity, but your capital is back with you to be deployed to a different investment. So we bring that up because IRR is the one number trying to project when those kind of things might happen.
Yeah.
And they should break that down, obviously.
Yeah. And so as an investor and real estate investing, probably more so than any other type of investing, is a long-term investment, right? So IRR, I'm a big fan of what we talk about all the time, compounding investments. IRR is basically telling you how quickly you can compound your investments. Obviously, like we talked about, if we refinance or if we paid high cash each year, every time you get sent money from the investment, that is technically money you could reinvest in a different investment. And even though it's the same dollar, that $10,000 that you invested in the first deal, you get it kicked back in year 4. Now you've got the original investment and you've got the $10,000 back, and you can put that $10,000 back to work. And the quicker you can do that, obviously, the faster the compounding goes. So serial investors like me oftentimes obsessed with IRR because we want to know how quickly can I make this $1 that I have, how quickly can I put it into second, third, fourth investment? And that's all IRR driven. That's all internal rate of return.
So seeing as it's like the one that's the toughest to kind of get into the math behind, and of course you can compare it to the other metrics to kind of get a sense of it. Is there a way that, say the first time investor is looking at IRR and they say it's 14 or it's 12, or this one seems a little bit tougher to kind of say, okay, range, sure, it doesn't matter. Do they look at, you see what I'm saying? It's a little bit tough. Is it like, look at how many years this projection is based on, right? Ours are standardly 5.
So IRR is more it's intended for seasoned investors. And the reason is because it can be manipulated very, very easily to sky high IRR by building your spreadsheet, calculating very early refinance or whatever it is that you do. You can manipulate the IRR. So it's intended for seasoned investors who understand the IRR and have done calculations and have done multiple investments. It doesn't mean that a beginner investor can't care about IRR, but typically a beginner investor, this is like your first or second investment. You're less concerned with compounding. You're more concerned with what is this investment going to do on itself. If it's going to double my money, that's awesome. I don't necessarily care how quickly I get most of that money back of doubling. I more care that it's going to double my money, and I'm understanding why and how it's going to do that. As you grow in sophistication, you care more about the IRR metric because now you're comparing, let's say, similar syndication investments. You go, both of them are equity multiple of 2. They're both going to double my money, and they're both going to do it in 5 years. The best way to tell the difference between them is, hey, like we talked about cash on cash, this one has a higher cash on cash. Maybe its safety margin is higher. So for the same return, I'm getting safer returns, or it's a safer investment. Maybe you choose that way, or maybe the same return, but it's paying out bigger chunk quicker, and I can reinvest. So it's a way to compare two very similar investments, that IRR. And it's also like, hey, how quickly can I make my next investment, which is important. But again, it takes into account the opportunity cost, like we talked earlier. So the longer my money is left in a particular investment, the higher the opportunity cost on other potential investments. And that just gets super complicated. And if you're not an experienced investor, you don't much care about that. You're more concerned with, hey, is my investment safe? Am I going to make a good return compared to the stock market or whatever on this investment? Those are things you care about more than probably the compounding rate, things like that.
Okay. So total return, annual return, and then reading the cash on cash, which can be pretty straightforward. It tells a very specific, straightforward story, I guess is a way to say.
Yeah, it tells more of the story of the business plan, the investment, how and why you're going to make the returns, and it just tells a more detailed part of the story.
And then preferred return will tell you basically the manager's approach, how they're incentivized, how they structure this deal. It tells you something about them and their confidence in it, but primarily their approach to putting together syndications, depending on, obviously, if you're comparing all of the things being equal. It doesn't mean that they're wrong if one's higher and one's lower. It just is insight. Okay. Well, I think we're going to wrap it up there. That one took a little bit longer than part 1 because there's a little bit more to talk about.
Yeah.
But as always, we really appreciate you guys listening and hanging out. And if you have any questions, comments, thoughts, etc., feel free to reach out on any platform or through the website, capitalvelocityinvestments.com. As always, we appreciate you hanging out with us, and we hope you come back and do the same next week on the next episode of the Get Invested podcast.
Yeah, we'll see you.